Good afternoon, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am going to do something I have not done yet, all in response to subscriber feedback. So I've never made a portfolio review before, or at least a portfolio update video before. And I'm going to make that, or at least attempt to make that today. And I've got a script, to be honest. I've got some guidance, but at the same time, this is very new, and honestly kind of intimidating in the sense that it's new and I've not done this yet. So we're going to try it out and see how it goes. So the normal disclaimers. This is an unedited video. Who knows what you'll hear in the background as I film these in my house? Hopefully not much because my crew is not here and the cat is asleep. Um, so hopefully not much. I am not a financial advisor. I am a strategist and a financial strategist. And I don't speak like the herd. I walk in limited company and sometimes I walk alone. And hopefully I'm pretty unfiltered, or in the sense that I'm still professional and at the same time without a filter. Um, and then as for YouTube, it's the normal stuff. Help me get the word out. There is, gosh, the traditional advice on the market is extremely suffocating and limiting. So help me get the word out that there is a better way to invest. There's Gosh, there is such a better way to invest. So you're building principal without selling off principal. You're using your dividends to power through and either fund your life or supplement your retirement or completely pay for your retirement. So if you like my content, like the videos, comment, and then share them wherever you are. I shared one today on a random Facebook ad that um, oh, we'll say they were offering a dividend strategy that I disagreed with. Um, but yeah, so help me get the word out. And yes, I mean the goal is to grow the channel. I mean that's the reality of every channel. But the bigger part, honestly, is helping more people know that there's a better way to invest. And yeah, there's a better way to invest. We'll just leave it at that. So I don't exactly know how to start this, so I'm just going to really jump into it, and we'll just see where it takes. So let me share my screen, and we'll get to it. All right, the Zoom thing. All right, let me move my viewer bar out of the way. All right, so this is the actual portfolio. I mean, no account numbers. I have them marked for where they are for the most part. Um, but we run two different portfolios. We run, so this used to be the individual account or the individual cash account at Webull, but I've since moved all of that into Fidelity. And my goal is to move the Roth into Fidelity. And honestly, I've been kind of lax about that. We've had a lot of other financial changes going on. Um, Webull is the online feature of it's like Apex Financing, something like that, Apex Venture Financing. But uh, there's a there's a transfer fee associated with moving your account from Webull somewhere else, and it's figuring out the transfer fee to where that fee does not come out of my Roth account. So that's really what my holdup is now. And the great thing I found out is Fidelity will actually pay the transfer fee. They'll do it after the fact. Like if there is a transfer fee, and there is, with proof of me paying the transfer fee, they'll just fund me the money back. Uh, but it's still jumping through all the hoops. But my goal is to get all of our financial investments under one umbrella to help my, I don't want to say descendants, but really to help anybody who carries the torch after me. And that's not to say that I think I'm going to die tomorrow, but nobody knows when we're going to graduate to the next life. So uh, I'm trying to make it easier for whoever continues this game. Um, so let's see. So the Roth portfolio, I keep track of our contributions. Quite honestly, the goal for us would be to add a secondary Roth account. Now, the great thing about the Roth is that your contributions into the Roth can be withdrawn at any point without penalty. You cannot take your earnings out of the Roth early. You, if you take your earnings out of the Roth early, you're going to pay a penalty. But so long as you jump through all the hoops, you get your earnings at the end, earnings contributions at the end, tax free. It gets notated on your taxes. And currently, we'll see what Congress does with the tax law right now. But if you end up not paying taxes, then you really have no worries. But the Roth account benefit is that whenever you decide to take the money out, it's tax-free money in the sense that if you take it out of your IRA, it gets added to your overall income, and the Roth doesn't do that. So you could completely liquidate your Roth or take whatever contributions you're going to take out of there. Either way doesn't impact your taxes. But the limit of the Roth is that you're limited on how much you can put in. So if you're going to be investing more than 7 grand a year and you want some more leeway or leniency or wiggle room, or you treat it like bowling and not so much a gutter, but like a wider area. If you have more than 7 grand to play with, then a Roth is kind of limiting because you can only do 7 grand a year. On our end of things, we haven't done much so far this calendar year because, quite honestly, I mean, like, yes, we could take our dividends from the cash brokerage account. We could take our dividends there and apply them to the Roth, knowing that they'll be tax free eventually. But it's kind of hard to rob Peter to pay Paul. So the goal is to, yes, max out our contribution for 2025. But to be quite honest, we have until really April 15th next year to max out 2025. So, and that's kind of the gray area in starting any investment account. But like if you're starting a Roth next in 2026, you can put double the years, currently 7 grand minimum, right? So you could really put 14 grand into a Roth next year, so long as you do it before your tax record date. Let's see if I want to say anything else on this. Right. So when we started, we started in 2024, but we added 2023 numbers one day. And then we waited a day, I think, for that to clear, and then added 2024 after that. And then that allowed us to start off the account with 13.5 and have a lot more money to invest than doing it monthly. I know this only because I've done it so much. I mean, 7 grand divided by 12 is not an even number, but essentially it gives you 583 and change a month to invest if you do it consistently monthly. Or, I mean, however you fund your account is however you fund your account. So I'll leave it at that. So I wish I could show you the entire portfolio view without completely shrinking the numbers crazy small. And I just don't have that capability on the screen. So all of the funds over here, they're all monthly payers. We bought them on different dates. That's what all of these individual lines are. I like tracking individual line buys, kind of like line item purchases. And then I track the overall average. So I track the average compared to the current. And then I track how each set of buying performs. Um, let's see. So you get our current average share price. I mean, you can track, kind of do math in your head between this total investment versus what it's worth. I mean, I like my spreadsheet the way it is, but the easiest way to show you is just to delete 3 columns right now, which always tends to throw off the spreadsheet a little bit, but it'll revert back as soon as I undo it. So you get to see how we're tracking overall. Now, the Roth does not have as much money as the Fidelity cash brokerage account, so the profits are different. And I'm not saying that as an excuse. It's just, I mean, you're going to see a difference overall in dividends. I mean, we've got 14.8 invested, which is a little bit more than that, to be honest. I don't know where the deviation is. Um, but then you see the overall annual dividend, the yield on cost, and then et cetera. So as we go line by line, I'm not going to get into every reason we bought funds, But since we started the Roth and really through now, it has been a bond focused bond, like bond land buy season, or say bond and bond proxies. See, of the videos that I've done recently that pertain more to the cash brokerage, I include this info as well, but you get bonds, CEFs, crypto, metals and minerals. CIF is corporate bonds, but it's a really small company, and we bought it on a roller coaster, knowing that it's that weird part of knowing that the Fed at some point will cut rates. The value of the fund will come back up, like everything else will, and we'll ride the roller coaster as the fund goes back into like goes back into a higher value. We'll sell it and then push the money forward. But riding the roller coaster is riding the roller coaster because you don't know where the bottom of the market is. You don't know how long it's going to take to ascend, right? And you want something that pays a decent dividend on the climb. And it all comes down to how you play the strategy. Like CIF, we bought knowing we would sell it when it tops to push the money forward versus BRW, FCO are more either lifetime or long-term holds. We'll kind of see how the market goes. HFRO is real estate. HCLB is that hodgepodge that used to be more bonds, real estate, utilities, and now it's a little bit more. NBXG is 5G tech. OXLC is senior loans and collateralized loan obligations, and a fund that predominantly sells in premium. But saying that doesn't mean that the fund will automatically push higher, like even when it's lower. So like right now, our overall return is under like our dividend income is great, and our overall value is down. Where we go, right? Average buy at 496, currently 50 cents under. So even when it's worth, not that it's worthless, when it's valued less, it's still in premium because its assets, people value its assets more than it's actually worth. Uh, and CLOs and companies like OXLC react like every other company to the perceptions of the market. So when the perceptions of the job market are that we're going to have a larger unemployment rate, they, for whatever reason, they tend to decrease in value regardless of the actual unemployment rate or regardless of the jobs report. And then RFI is a real estate company. And then all of this is encapsulated, or I won't say trapped, but all of this is inside the Roth. So if at any point we needed to withdraw our contribution, then we could take the money out tax free. Otherwise, it's inside there, ideally, until we retire. And then we can take the money either on recurring withdrawals, we can take it out all at once, or we can just let it sit and grow larger. In the Fidelity account, it's the same thing. And I get this isn't exactly maybe the portfolio. I need to go back and undo. That way I get my columns back. This isn't probably quite exactly what you asked for, but I'm getting to that. And this portfolio is set up the same way. It's predominantly bonded bond proxies, except that, I mean, DSL is corporate bonds. I moved over our initial Webull portfolio. So it's got a little bit of other stuff. That's real estate, that's oil, that's oil and energy transfer. That's a hybrid fund. Uh, it kind of 70-30, I think, now on equity versus overall bonds. Uh, I'll just go back to the top and kind of scroll through. So some of these, I know they're marked certain ways, but they're also not set in stone. I mean, it really does depend on how the market shifts. Uh, Real estate, oil are very cyclical in nature. in the sense that once we finally build up a world supply of oil, if we really do top it, not during COVID, but if we really do top out the over, like everywhere is supplied in oil, you can expect the price to fall because there is so much of it. The total volume has reached a point that it's not being used. If the world pumps up oil like it did 6 years ago, then oil prices will fall. And then we respond with either A, we want to ride that roller coaster train back down, meaning keep it knowing that the dividend would probably get cut again, and then hope that it bottoms out lower than where we are so that when we buy it, we can lower our overall buy-in price, knowing that it would cycle back through and escalate back up. We could do that, or we could just sell it where it is, watch the market drop out, and then buy it low. I mean, there's a strategy for everything almost. It really just kind of depends on your style. So we're set up very similarly between Roth and Fidelity. The major differences, uh, we brought over 4 or 5 funds when we transferred with Webull. That would be DSL, IGR, KYN, NML, and ZTR, 5 funds, which ZTR is on the sell block, or I say it's kind of on the platform waiting to be sold in the sense of we're if interest rates are cut, which I still think interest rates will get cut, but if interest rates get cut, everything should go back up. So we'll ride this roller coaster as well. ZTR average price generally sits between 10 and 12. We bought it not super low, but we bought it lower than that with the goal to sell it between 10 and 12. So we'll see if that happens. Uh, this this account holds 3 municipal bond companies that are essentially like tax-free money. Uh, I mean, for our tax bracket, it pays almost a 10.5% dividend. For this individual line, it generally sits 2 to 2.5 above the posted overall yield. So these numbers in the italicized funds are municipal bonds, and their dividends are always a little bit off because it is that tax equivalent dividend. All right, so but the actual reviews. So since I was asked for making these shorter videos, really 5 to 10 minute portfolio overviews, and I know I've probably eclipsed that at this point. This, I think, is really what people wanted to know. So this is what we bought, and they're labeled for Fidelity because we cashed out our Morgan Stanley money and we dropped that brokerage service and we took all of that responsibility on ourselves. And instead of just investing everything into the market in a one-off, it's been timely buys with like an overall dollar cost average approach with specific money set aside for individual, uh, say cyclical, but individual chunks of investment. So this is this chunk of that money. So the goal was 14.5 or less, and we spent just under 14, and we invested in these companies, which may be a lot of investments for 14 grand. I mean, that's 12 different investments. Maybe that's too much. I mean, by including more and more investments, you're actually limiting how much money you can put in different places. Like if we had gone with half, it would have increased our individual buys in 6 of the funds versus spreading it out into 12 funds. But regardless, this is what we bought. So we bought real estate. We bought pretty much a portfolio in a can, which we had 400 shares. So I bought an extra 100 and rounded it out to 5. FCO, corporate lender, but also the internal component of the private lender or a business development company. So big, big US based bond company, uh, well set up in the current economy. Maggie is utilities. Let's see, BRW I hammer every week. It's bonds and stuff, but it's bonds and crypto and other closed-end fund companies and metals and minerals, and uh, it's a huge shareholder advocate, um, and they also just pay a fat dividend. All right, OXLC we bought because it was on discount, and when it's on, it's kind of like it's that weird thing of if OXLC is on discount, even if it's a 0.5% on discount, it's a great buy. But being that it was at 8% discount, that's a fantastic buy. We bought more of DSL, which we carried forward out of our Webull fund. We bought, I want to say we had 200 before we moved over, and we bought a bigger batch because same thing, the discount widened. DNP is utilities. Um, let's see what notes I have. Yeah, this is out of Dividend Swing Trader with Brett Owens, which I can delete off the other end of things. So the key with DNP and a couple others, my triple asterisks are the funds that are uh, currently discounted greater than their historic discount and also higher than their 5-year average. So the key with DNP and the others that are the exceptions is we bought they're they are noteworthy when the current discount eclipses the 52-week average. In the 52-week low, I just track for my own purposes. 5-year at this point, I track for my own purposes, but this is really the metric. So the 52-week average for DNP is that it sells at an 8% premium, which is essentially like a dollar eight. So break even would be a dollar, an 8% premium would be a dollar eight, an 8% discount would be 92 cents. So when the current discount is equal to or less than the 52-week average, then it's a good buy. And you could argue at 4% premium, it's still a premium. And I would completely understand your argument. But for this fund that historically trades at a premium, the fact that it's 4% less or 4 cents less than where it normally sits, it's actually a discount for the fund. And the whole point of the asterisk is really not to pay premium, but at the same time, there are exceptions to the rule. RFI is real estate. One thing I like about buying through Fidelity is they really do take the prices out to the fourth decimal, which I only ever saw the rounded pricing on the Webull end. That being said, I like the dividend feature on the Webull app much better than I do on the Fidelity website. The best way to get dividend updates on the Fidelity website are to go through my individual account financial report at the end of the month and really sift through that to get the dividend values. And even then, they don't break it out well. But with getting everything under one umbrella, there's going to be some nuance to that. Things I like, things I won't like. And then we picked up another 100 shares of our municipal bonds. The other buy-in, so we had been consistently investing at the end of the month. If we go back and look at the overall portfolio, so when we started buying, and they tie in here, so January 27th, Fidelity 1, February 24th, Fidelity 2, March 24th, Fidelity 3. We bought the dip, we bought the tariff dip. So when everybody freaked and the market dropped, we bought early. In May, we went back to the end of the month. In June, we'll see. I'm not necessarily interested in chasing the next shiny coin. Like every single thing that glitters, glitters for a reason. And sometimes you have to know when to look away from it. Uh, so I'm attempting to be patient and not, it's like, oh, there's this thing that sparkles, and oh, there's that thing that sparkles. I mean, we could buy every day. And I want to be consistent in that dollar cost move. So in order to spread the money out further through a more we'll say a choppier market, I decrease the overall amount And then that allows for some of the dividend money to kick in and then kind of bolster our buys to where that what would be our six, seven. So this is five at 10. So 6 and 7 should be about 10 as well. Um, and then there might even be an eighth based on how much dividend money we've acquired before that happens. So for the last foray in, we still bought bonds. So we got bonds with the shareholder activist company, bonds with the BDC component. We did buy one stock fund uh, that's all focused on 5G tech. And I'll pull this up again. And this kind of like update week. This is projection of what the Fed's going to do. Everybody predicts the market. I mean, that every day, everybody predicts the market. Uh, but the contrarian income, Brett Owens with the contrarian income team just had his quarterly video. So I've got to process that. I've got more reading to do. I've really got to probably catch up on 2 weeks of reading, to be honest. Uh, Part of me says we're at a point where it's still very much a bond market, but there might be a way to invest. I mean, stocks, they've got to be on discount, but maybe there's a way to invest in stocks and still make some money on stocks, even though it's still excuse me, even though it's still a bond driven market. But we'll see. HFRO is real estate, and then we have our three municipals. So, of where it stands going forward, I mean, we've got two for sure additional buy-ins that should happen end of June, should happen end of July, but we'll see. Um, After that, I mean, we'll be reinvesting dividend money, raw fidelity. But how it sits currently, and I'm all for transparency. This is our I explained this last time. This is our dividend track record for when we were at Morgan Stanley. Uh, this is how much money the guy had to invest. This was how many dividends he was cranking out with mostly mutual funds and individual stocks. And we were getting just clobbered with his dividend strategy and overall vision for the account and our age and retirement status and jobs, like all of that stuff. So, I mean, if the Fed's lying, and quite honestly, the Fed's going to lie because their goal is to make themselves look better and keep power. So if inflation hits 2%, you can wager that it's generally more than 2%. So if inflation actually hit 0%, you could wager that it actually sits at more than 0%. So I'm of the notion that regardless of how the Fed spends it or anybody else for that reason, inflation generally sits at 3 to 4%. So in that, we're not even scraping enough dividends to offset inflation, which means our overall account value is just getting crushed every year. Currently, this is how we sit. I like to keep track of overall shares owned. I mean, overall investment. You look at dividends a month, annual, that's skewed because you have this tax equivalent dividend getting paid at some point. So it skews the overall yield. So our overall yield is actually higher, right? Just based on that tax equivalent dividend, but we're not exactly seeing it yet. And then we have our total accumulated dividends since we've owned the funds. Overall DOI or overall ROI since we've owned the fund. Current value, overall total ROI. We have, sorry, overall ROI for all the funds. Then we have a total ROI, which includes the dividend payments. But then if we sold the funds, this is really why this column exists. If we sold the fund, what we're profiting or losing just on share price. And I love tracking dividends and how they filter into the total ROI and what we're gaining. But if we sell it, the dividends are known and they're really reabsorbed into everything else we're doing. They're either sitting in the account and earning interest or we're reinvesting them. So it's not as if when we sell the fund, we're automatically getting that money back because it's been reinvested already. So to track just what we're making profit on when it comes to selling funds or losing profit on when it comes to selling funds, that's why these four columns exist. Somebody asked if I would post the spreadsheets, and that is the goal. I don't honestly know how to do that on YouTube for a couple reasons. One, I don't know if YouTube allows spreadsheets or documents. I don't know how to do that on my existing account. Two, even if I had a membership or a subscriber section, um, which I think would be really cool and amazing, I don't have those capabilities right now because of how many subscribers I currently have. So, in order for me to create a specific membership on YouTube, I have to have 500 subscribers, and I currently sit at 109. So, thank you very much to everybody who has already joined. It's really very cool to watch my channel grow. Um, I really do. I try to respond to comments. I like interacting with people. I like answering questions, and I like when people ask really poignant questions of like spell it out, like why did you do this? Uh, and that's part of why I make these videos is to justify what we're doing, which I don't have to justify anything of what we're doing, but uh, if I'm going to buy a fund, I should be able to articulate why we are buying that fund. If I'm buying it just because, then that's just not a good enough reason for me. I'm very, it's, I told my daughter this in regards to something else. Of the various things that are on my plate and the various things that I'm responsible for, I take my responsibilities very seriously. So to be tasked with self-investing, I mean, even if you trust a broker, you still have to trust your broker that they're going to do the best job for you. That's a very serious responsibility. So to realize that the broker you're trusting is investing your money willy-nilly and really, quite honestly, shooting you in the ass, I take that responsibility very seriously. So we removed his guidance, his we removed his advice, and he no longer sits at our table. Uh, we keep our advisors like it's not like we're charging access for our advisors table, but we keep and I talk about this in my videos. I talk about this in the book I'm writing. You need a board of directors for your life. Kiyosaki talks about the same thing. You need a you need advisors in your life who are they just hold weight, and you want them like you want the people who sit at your table, your advisors table, your board of directors table, who are interested in the same stuff you're interested in. Uh, we're interested in stocks and real estate and growing our wealth. To, like our CPA is the same. Our CPA is invested in stocks and real estate and growing his wealth. Uh, the the gentleman who manages our investment property manages a lot of other investment properties, has investment properties. Uh, the friends and family who sit at our board of directors are interested in similar things. And you don't always want to be the smartest one at the table because that kind of shoots the learner's mentality in the foot. You don't want to feel like a dunce. You don't want to feel like a fool, but you want to be able to continue learning from the people who sit at your table. And just to have somebody at your table simply because their family or your best friend or anybody for that matter, your broker, your real estate agent, what just because they're doing that stuff, even though there are real estate agents who are fantastic at selling real estate, but you really want somebody who owns property. I mean, yeah, in theory, they own their own house, but if you catch the real estate agent who lives in an apartment still and isn't exactly interested in overall value growth or the potential of your house in the next 5 years, that really does tend to set real estate agents apart. But if you could find a real estate agent that owns investment property, they would have a lot more insight into picking up the random real estate around, even for your own home, right? Somebody who understands the growth of the market and the risk of the market and uh, neighborhood ins and outs and just the potential for overall property will give you a lot different advice than somebody who's amazing at their job, who can buy and sell anything and who lives in an apartment, right? And that's not to downplay anybody living in an apartment, but it's a very different perspective. So the people who sit at your table, people who sit at your board of directors table, I mean, you're not charging them a fee for being there, but you want to be highly selective of the people who sit at that table. And our past broker sat at our table and we realized what he was doing and we quickly changed that. And we weren't rude about it. Um, but at the end of the day, it's your money. And if somebody else is if you're trusting somebody else to invest your money and they're doing a shitty job, then you have every right or every reason to let them go politely, professionally, but let them go and either find somebody else or take on the responsibility of doing it on your own. And in either sense, it's a much bigger responsibility. But when you take it on and do it on your own, it's a much bigger responsibility. So I can't just invest in anything. I can't just follow the next shiny thing. It's got to be a specific investment based on strategy based on targeted strategy with a long-term game plan in mind, and something that my whoever that whether my wife, my daughter, or anybody for that matter who takes over the portfolio can keep up with. So it matters to me. Like I've got to be able to articulate it. It can't just be just. And I've said this before. Like it doesn't feel like a good thing. Like there's times when that applies, right? Like if I'm thinking of doing this and I'm thinking about it and I'm attempting to justify it, and I'm attempting to rationalize it in my head, and I can say all of this stuff, but it just doesn't feel like a good thing. It's just because there's part of your brain that deals with feelings and this overall deeper sense of this doesn't make sense. When that happens, I've learned to trust those feelings. Right? It just doesn't feel right. I can't put it into words, but it's just there. It's a different part of your brain that just it lacks the ability to articulate, but it's trying to be like, hey, and it's trying to put it in your face, be like, hey, pay attention. Those are important things to listen to, right? But at the same time, if I was like that all the time, it'd be really hard to invest. So it's very important that I be able to articulate what we're doing and why. And that's part of why I make these videos. Part of it is to help people realize there is a better way to invest. The other part is on my end, and that I can actually justify what we're doing week to week, month to month, overall. This is a strategy. This is how it plays out. This is how I'm staying faithful to that strategy. This is how we're investing in alignment with that strategy. And on y'all's end, if you ever see me break it, then you get to hold me accountable for it. Like, hey, you're not following what you set out. Probably something I should know. So I would appreciate some grace in that. Like call me out however you want, but at the same time, I would appreciate some grace. I would appreciate some professionalism, but at the same time, you do you and call me out however you want. Uh, but I honestly didn't know how to make these videos. So this is what I got. So if you have feedback, give it to me. Like this sucked, which would not be ideally professional, but actual critiquing, like, hey, this worked. Hey, this didn't work. Hey, can you show this instead? Hey, thanks for the video, but I was really looking for this information. I like that stuff because it really does help me make the next video. And the next time we make a buy, which really should be the end of this month, if I stick to schedule, it'll help it. I'll make my make the decision on what we buy based on strategy. But at the same time, when I make the portfolio update or review for that, say the portfolio, whatever, when I make the next video for that portfolio update, I'll have a better idea of how to do that video. So I hope you like it. Um, let's see. This was April at the tariff dip. This was May, overall different amount with the goal not to spend it all, which we didn't. Um, let's see. Average based on the list, average including those tax-free dividends, right, which is about 1% off. And that's really all I got. So um, I still have the weekly strategy video to make this weekend. I've got a lot of stuff to read between now and then, a lot of stuff to process between now and then. But if you like my content, if you like hopefully it's down to earth, pretty straightforward, pretty unfiltered in the sense that I don't speak like those other jacklegs on TV. But if you like the content, then subscribe. If you like my content, if I could talk, it'd be great. If you like my content, consider subscribing to my channel and then help me heck YouTube and leave a comment, share the video, click the like button, and really share this with other people to let them know there's a better way to invest. If you want to find me day to day, comment on the video, and I will try to figure out a good way to share the spreadsheets. Uh, oh, best ways would be to open up a platform on a different site. And of the options, the two most prevalent sites would be Facebook or OnlyFans. And OnlyFans is trying to make their uh, online persona a lot different than it currently is. There's a lot of other stuff on OnlyFans than the stuff they're known for. So they are attempting to shift their overall online image. Um, but I don't know. I've still got to work. I've still got work and some investigation to do on that. But I will find a way to put put the systems online to where you can get full access or have all access to I mean, it might be posted every week, but then that way you could have full access to the overall closed-end fund list, make your own selections. Uh, I could share our portfolio, especially like when it changes, but share our portfolio. And then, I don't know, maybe I can do a video on, but I can both post the spreadsheet of keeping track of your value and then how I track dividends, which I didn't show, but and then how those spreadsheets communicate to each other. We could kind of build a spreadsheet for your portfolio. Um, I don't know the possibilities. I'm sure the possibilities abound. So leave me a comment, and then I will make another video this weekend on either Saturday or Sunday. And then I know I still have a video that I owe you. I still have the overall closed-end fund strategy that I'm still working on. Not so much that I'm working on the strategy, but I'm working on writing it out and making sure I cover everything. So I hope you have a great day. Hope you have a great rest of your week. And I think that about covers it. Um, yeah, I wish you well, and I will see y'all on another video. So have a great day. Bye bye.